All right, hi everyone. Hope you're all doing well. And glad you can make it out to the webinar today to have a chat with me and John. So just to introduce ourselves, we'll have John Scott from Fraser Scott Co, who will be talking about the tax and accounting side of acquisition. And then as well, you'll have myself, who is a senior lawyer at LegalVision, dealing with the legal side of things. And before we begin, just want to cover off a couple of housekeeping things, just so that you know. You'll get a copy of this webinar, so don't worry about notes if that's what you're after. You can kind of go back and look back on the presentation and the recording of it. And as well, throughout, you can submit some questions. We already have a couple questions now, but if you do have other questions, you can send them through. We might not get to all of them, but we'll do what we can. And as well, there'll be a survey after. So let us know your thoughts on the presentation. It's always good to hear feedback, so that we can keep improving them. All right, so in terms of the content we'll go through, there'll be kind of a hybrid approach, like I said, since we have John from the tax and accounting side and myself from the legal side, but basically we'll go over the difference between a share purchase versus an asset purchase, look at the pros and cons of that, a bit more specifically from a tax and accounting side, looking at whether the deals are equal from a share purchase or an asset purchase. Then we'll look at the actual agreement, the share sale or business sale agreement, and then as well whether there's an advantage to merging or keeping entities separate, and the due diligence that you as a buyer would want to conduct before buying a business or buying the shares in a company. And then, like I said, we'll have some question and answer time at the end, so you can submit your questions throughout, and we'll go over a couple things at the end in terms of the kind of additional value points we think that might help everyone. Perfect. So hopefully some of you guys have a general understanding of acquisitions. No need for any background information though, because that's what we're here for. So generally speaking, there's two types of acquisitions. One is referred to as kind of an asset purchase, or is sometimes referred to as a business sale or purchase. And so this involves the purchase of the assets of a business, say from one company. So company A owns an online tech business, a software business, and it is going to be selling it to company B. So all of the assets are being transferred. So the contracts with clients, any equipment, and the like. So dealing with the different parts there. One thing that comes up quite a bit is the liabilities and how they're treated with a asset purchase. You as the buyer are not necessarily taking on liabilities of the seller's business unless it says otherwise in the sale of business agreement, is the general approach. So the carry-on approach is that with employees, typically you will take on some of the liabilities there. So if the employees are technically terminated from the seller, re-engaged by you as the buyer, but because of employment legislation and there not being a break in their employment, you will have to honor their employee entitlements as to personal leave and long service leave if those are applicable, and potentially annual leave. And so there can be an adjustment for those entitlements because you're taking them on. With a share purchase, a little bit different. What we have here is that with company A, there's shareholders. What's happening here is that you're purchasing the shares from the current shareholders of company A. You're coming in to control company A. None of the assets are transferring. They still sit with company A. From a client point of view, an employee point of view, everything stays the same, except that the kind of key people at the top are changing in terms of the shareholders. There might be a CEO that's appointed, otherwise but generally everything stays with the same company. The assets and liabilities stay with that company A, so that's something that John will go into the kind of skeletons there, and why we have to do a bit more due diligence with employees. All the contracts remain, but there's a due diligence piece as well.
Thanks, Matt. So just looking now at the pros and cons of buying shares versus buying assets. With the share purchase, there's no requirement to change the business name, so you just trade on as normal with the same bank accounts, same ABN, etc., etc. Potential to access carried forward losses if conditions are met, and I'll talk a little bit about that later on. Shares in a company are easily traded and they're understood well by many people. And most customers won't notice a change in ownership. If you've got sophisticated customers with agreements and contracts and whatnot, there probably will be a change of ownership condition in those, but in many cases, if it's a retail style business, then they would not know the difference. The pros for an asset purchase are that the buyer can cherry pick which assets that they want and which liabilities to accept. You can do that a little bit within a share agreement as well, but that's much easier in an asset purchase. And there's no skeletons in the cost. It's mitigated because you're picking out the assets that you want. You're not taking on any of the known or unknown liabilities that the company may have. On the cons for a share sale, as I said, you might discuss argument. There might be some undeclared or unknown liabilities there that pop up after the sale's occurred. For that reason, you need to do more due diligence on a share sale generally than on an asset purchase, and that may result in possibly some higher transaction fees as well. On the downside for the asset purchase, the buyer needs to renegotiate all the existing business contracts, open up new bank accounts, get a new ABN, etc., etc. And setting up a new company and renegotiating all of those contracts can be a little bit time consuming. On the next slide. So the question is, I guess, if you're buying a tech business and that's operated through a company structure and you're buying it off the founders, and so you're looking at it from their position now, if you offer to buy shares for 5 million and another bid is offering to buy assets for 5 million, which of the following statements do you think might be most true? Both of the offers are equal. 5 million for the assets is probably more attractive to the seller. 5 million for the shares is probably more attractive to the seller. So we're just going to do a bit of a poll now. And if you want to click on your screen there and just indicate which ones you think might be the case. And then we'll have a bit of a discussion about the answers that come through. Just waiting for those results to come through. Might be a minute. A couple more responses. Okay, so here we go. No one said that both offers are equal, which is interesting. 36% said that the assets are probably more attractive to the founders, and 64% have said that the shares are probably more attractive to the. That's exactly almost a third and 2/3, which is very interesting. Okay, let's have a little look at some of the considerations before we give you an answer. So the first thing to appreciate is that with capital gains tax, there's a general capital gains tax discount of 50%, which applies to individuals and trusts, and it's on any asset that's subject to capital gains tax, as long as it's held for more than 12 months. But the 50% discount is not available to companies. The second thing to think about is that what money is going to end up with the founders, because that's all they really care about at the end of the day. So if you sell the shares, any money that they get is taxed at the individual level. So it's dealt with at that point, and the money after that tax is paid or dealt with is theirs to do as they please. If the asset sale is done through a company, then the tax is dealt with at the company level. And then in addition to that, if the owners want to get that money out, they'd need to pay some top-up tax on the tax that the company's paid because the tax rate's lower. And to extract that money from the company, or they'd have to wind up the company and get a return of capital. Now, I haven't today gone into the small business concessions that might be available to these founders. That's for anyone with a turnover of less than 2 mil or assets of under 5 mil with other conditions being met along the way. I've ignored that for the minute, but they may or may not be available to the owners. But just looking at it on a gross basis to get an indication from the seller's perspective of what might be more attractive. We'll move to the next slide now. I've done a little table here, so I'll give you a minute to take that in. But in the middle column there, I'm looking at this from the perspective of the share sale. So this is the money that the owners would see after they've paid their tax. So both bids for the share sale there, and on the right there, the asset sale of $5 million, and both cost bases are the same, which is 100,000 for each. And so the gross net capital gain that we've got to deal with for each of these sales is 4.9 million. And concentrating on the middle column there for the share sales, the general discount's available at 50% discount. And so if we take that off, then the net capital gain we now need to deal with for the shareholders is 2.45 mil. Now, just assume for the moment that they're going to pay the maximum highest income tax rate on that. So their tax is going to be 1.15 mil. But what that means is out of that 5 mil, less the costs, less the tax, they've got 3.748 mil in their hands, and they walk away with that. There's nothing more to pay, and it's available to the vendors. Now, on the asset sale, you've got that 4.9 million at the third line there to deal with. The general discount's not available, but on the upside, the company only has to pay 25% tax. And so if you take that tax off, then in the hands before the initial level, there's 3.675 available for the company. Now that's fine if those funds are going to stay in the company and it's a company purchasing or whatever it might be, but it's still less than what the sellers would get. If you can see there on the left, they're getting another 3.7 versus 3.6. If they want to get that out as they are able to on the share sale in the middle column there, then they'd have to pay top-up tax immediately to do that, which would be 22%, which means they'd only end up with 2.56 or 2.6 versus 3.7. There are ways of reducing the tax, as I said, with the small business concessions, or alternatively, you work through a wind-up situation within the company. But on the face of it, you know, a share sale is often, and this is reflected in real life as well, is a share sale for founders is often going to be a much more attractive and easier scenario than going through an asset purchase. Now Matt's going to go through a bit on the sale agreement for us. Thanks, Matt.
Yeah, so we can just click through those ones, yeah. So in terms of the sale agreement, you know, this is a key part from a legal standpoint. So John's gone through kind of, you know, the initial points when thinking about the deal and what type of transaction might make sense, you know, from the buyer's perspective in terms of giving something attractive to the seller and kind of having an idea of what they will get out of it depending on the deal size. We want to look at the actual sale agreement to see what was actually being included there. So as the buyer, there's a couple things that you actually want to make sure happen before the sale completes, and it's helpful as well to talk about a bit of the sale process quickly. So generally, you would have a draft agreement. It would be drafted by the seller's solicitor. It would then go to the buyer's solicitor. There'd be a negotiation stage, and then once all the points are agreed, the document would be signed. So that's what we're referring to signing. And then between signing and completion, there can be things that happen. So completion is when the business is actually transferred or the shares are actually transferred ownership. So these conditions precedent are things that you want to make sure happen first. And as the buyer, obviously finance can be key. If you have bank finance, you want to make sure you're getting formal bank approval before you have to proceed with the deal. If you're doing a business or asset purchase, making sure the lease can be transferred and the landlord's consented is key. As well, if there's key employees, making sure that they accept offers of employment before the sale can complete. So as the buyer, before the whole business is transferred over in an asset purchase, you're making offers to the key employees. They're then, either negotiating or just accepting. And so if these conditions precedent aren't satisfied, this means that you as the buyer don't have to proceed to completion. So they're basically your protections. The other kind of protections are warranties and indemnities. Can be a bit of a dry legal point, but are helpful to understand. So generally speaking, how I talk about warranties is that they're the promises that the seller makes about the business. So it's not a warranty like a traditional 2-year warranty when you buy an appliance. They're just promises the seller is making about various aspects of the business. So these can pretty much include promises over anything, and since you're the buyer, you might have done some due diligence, but you don't know the ins and outs of the business, so this is what you're relying on, some of these warranties. So talk about the seller complying with the lease, that the seller has all relevant licenses, that the employees have been paid all relevant amounts, and how this works then is if one of these warranties is untrue and you suffer a loss, then you can bring a claim against the seller to the extent of that loss. So if employees weren't paid all their super and it's a share sale, then you as the company would still have to pay those amounts, but then you'd be seeking to bring a claim against the seller of those shares. And the other more kind of procedural pieces here is the actual transferring of assets in an asset sale. So the business sale agreement deals with the transfer of the legal title to it. The second part is the practical transfer of assets. So this can be, if there's a premises for the business, typically the assets would stay there because you're taking over the lease, and you would simply, enter possession of that premises and continue to operate the business. And as well can include transfer of equipment leases. So if there's rented equipment, that's also something to kind of cover off early in the piece, because you want to make sure you understand what you're getting ownership of. And generally, with rented equipment, it's owned obviously by someone else, and so that should be factored into the purchase price.
Okay, so now you've purchased your business. What are you going to do with it? How are you going to structure it? And so I'm just on the next couple of slides, I'm giving a couple of ideas of structuring. But before we do that, of course, we structure and put things into different companies and trusts and things like that to reduce risk. So it avoids all eggs being in one basket. So if something goes wrong with one of the businesses or one of the operations, then you don't lose everything. Maintaining separation reduces the risk overall. And separation is managed through structuring of businesses, as I've said, and it's generally done through a holding company arrangement, whether that be a trust or a company owning the shares in the operating business, and another owning shares in the asset holding business. So on the next slide, it just gives visualizing risk, a bit like a room in a house, or where you've got your super in one room and business operations in another room, investments in another room, and business assets in another room. And also it's common to take out accumulated business profits and put them into their own entity as well to protect those. So let's have a look at if we buy this business and what we might do here. If you look at the blue icons there, that's what's existing before the purchase. So you might have a buyer with a home and superannuation, and they've got another existing business which is very successful in its own right on the right there, being existing business, and that could be owned through a family trust or directly, it doesn't really matter. Now they're purchasing this new IP business, and in this case, they're going to put it into a new company or buy the shares in the new company and then own that through the trust. Now, if we look at the next slide, and you've got an issue with the takeover and things don't quite go as planned, and your distribution model, your monetization model is not working, they've lost everything. They've lost the business and they've lost the IP. Now, another way of doing that would be on the next slide, where if we put in at the top a new group holding company, and we're to separate out the distribution business on the left there, calling the SaaS business, which is a subscription model. And on the right, if we separate out the intellectual property assets and put them into their own little company, then you can see on the next slide that if your distribution model doesn't quite work out as planned, you've lost that SaaS company and you deal with the fallout of that. It's not going to affect anything else in the structure necessarily, but it gives the opportunity there to revisit, well, what were we doing to monetize this IP? Is there a better way of doing that? And you may have a second bite at the cherry to salvage that asset and that business. So that's just a simple illustration of structuring and how beneficial that can be. Matt's now going to take us through a little bit of the due diligence on the legal side, and over to you, Matt.
Thanks, John. So in terms of due diligence, we're talking about two types of transactions here, so it is good or useful to kind of differentiate the two. And like John has flagged earlier on, the kind of concept of skeletons in the closet is one used for a share sale. So you're buying the shares in a company, and so you're taking over all of that company's obligations, which can be obligations under the contracts to the clients, can be the obligations to pay tax to the ATO, which is a one that's heavily negotiated and looked into. So you want to make sure that you understand what you're buying, as well with the business sale. The assets are being transferred to you, but you still want to make sure that the assets are validly owned by the seller. So IP, we're talking about for registered ones, trademarks or patents, fairly easy to search, and you can make sure that they're owned by the actual entity that they are saying owns it. This is a process that's helpful to do before the actual sale agreement is signed. So often due diligence can happen at different stages. As a buyer, you want it to happen as early as possible. You can sign a heads of agreement or like a confidentiality agreement / like a non-disclosure agreement to make sure that you've given the seller some comfort, but you want to make sure you know what you're buying before you've kind of gone too far in the sale and negotiation process. Just going back to the IP there, for other types of IP, it's a little bit more complicated, but basically you want to make sure the ownership trickles down. So with employees, if they're key to making certain code for, if it's some sort of tech business and there's a software that's providing that, employees are developing that code, you want to make sure their employment agreement talks about the assignment of the IP that they create, or if it's being created by like a third party kind of consultant or contractor, we want to make sure that the ownership vests with the company. With contracts, we want to make sure that those are fit for purpose generally, and employment agreements want to make sure that they cover off the relevant requirements, and as well they align with Fair Work Act and the what the employees are owed. And so we want to make sure that we've gone through that process. And like I said, there can be a distinction between the different types of sales. So with a share sale, you're taking on the employment with all the contracts, and with a business sale, you're free to put in place new contracts for employees and potentially with other providers. So it's a bit of a different process there. And this is just talking about the client contracts. So depending on where the business gets its value from is where you want to focus the relevant due diligence. All right, so if there's ongoing client contracts, which are the kind of key value of the business, and even if it's a business sale, so there's a new legal entity that owns it, we want to make sure that those contracts can be transferred. Right, if they can't be transferred and the business is being valued off ongoing 2-year, 3-year contracts with clients, then we want to make sure that there's relevant provisions in there. There can be kind of deferred payments that are going to be made depending on whether or not those clients continue to engage the business. So there can be ways to address it, but we want to make sure we know what's in place before the sale agreement is signed. And with share sale, there's no transfer of client contracts. And the only thing you're looking at is if there's a change of control clause, which means that you need to get their consent if there's a change of control of the company. So that's common for like a lease or a franchise agreement.
Thanks, Matt. Oh, sorry.
Got one more here. So yeah, with due diligence, we want to make sure we understand where the risks are, and so what we do with that is we can address these by putting in specific warranties that deal with those risks. Here we're talking about those are back-end protections. So because a warranty allows you to potentially to bring a claim, that is a protection, but claims involve additional costs, stress, expense, potentially litigation, which obviously is not the ideal scenario. So prior to going ahead, you want to make sure that through the due diligence process, you understand exactly where those risks are and can decide, from the outset if you're comfortable with that. And then as well, to the extent, there is some kind of outlying risks that you're happy to just rely on warranties with the ability to bring a claim. And like I said, other protections can be put in, like having deferred payments, which are, subject to certain things happening, like all clients kind of staying on board, or certain things, not having a breach of any warranty. So there is additional protections that can be added in where there is risks.
Thanks, Matt. Look, on a practical level, from an accounting perspective, when we have a look at these things, one of the basic things we do is have a look at the ATO portal for the business. Accountants have got access to that for their clients, and just cross-check the business activity statements that have been lodged with the ATO against what we've been provided in a sense, and also check that the business activity statements sort of relate to the financial accounts and tax returns that have been prepared too. That's a great check. ASIC's got some very good information there in regards to band directors and whatnot, which is also helpful. Verifying the assets and the market values, preferably independently, is a good step. Reviewing the debtors and making sure that the debtors exist and that they're collectible. Looking at the creditors and making sure that the creditors that are given all it's owed. There's no invoices or anything missing. Looking at the work in progress or the client billing list and giving consideration as to when that's billed, what percentage has been billed, and making sure that nothing's been pushed forward or deferred back. Looking at the loan agreements and making sure that they're loans that the company wants to take on. Check the payroll leave balances and provisions recorded, and you can making sure that the annual leave that's displayed is all that's owed, and the long service leave is being recorded correctly and accrued in the accounts, and making sure that any key people that are responsible for generating the profits that you might be paying for are locked in and coming across with you. Working capital and working out what's required to run the business, and undistributed profit considerations are also quite a bit of a sticking point when it comes to adjustment values at the end of the negotiation. So it's nice to get those agreed up front so that there's no surprises. As I said, well, as Matt was talking about, if it goes wrong, if you can mitigate this through warranties, indemnities and guarantees, but that's not great. You want to really have that sorted out before you get to the point of needing to rely on those. On the last slide here, something to consider with one of these businesses may have carried forward tax losses. If you just go to the next slide, please. It may have carried forward tax losses, may be available to the new owners. To utilise this, if the company's changed hands by more than 50%, so if you've bought 75 or 100, then you've got to pass one of the two business test, which was very, very difficult to pass. But then in 2015, the similar business test was brought in, which is easier to satisfy. But you really want to make sure that if you want to utilise those carried forward losses, that you cover that off as part of your diligence before you sign the agreements. That's it for the presentation, I think. So back to you, Matt.
Yeah, thanks, John. So in terms of kind of takeaways and additional things that might provide you some information or value, we do have a buying a business guide in negotiating the terms. So I think this is, a useful one to look at, but and to kind of think about, maybe discuss. But I always think that it's good to have a chat with solicitors or with the accountants as early as possible in the piece, just because, once things are agreed between people, it's a little bit more difficult to step backwards if that doesn't really work from, a strict legal point of view or from a risk point of view or whatever. But this gives you a kind of guide as to what the key things are to focus on. So you can have a download of that. And another presentation that we have coming up is on corporate governance. So, probably a one that's not as well kind of talked about, but is very important, that you're upholding your duties as a director. And so understanding, what the director's duties are. So those are kind of obligations that come from the Corporations Act, and can include personal responsibility for directors where things don't go as they should. So I think that's a really important one for new directors. So you're across generally what your obligations are, not just to run the company, but to do things like not to trade while insolvent, which is probably something that John agrees with. And so we've got some questions beforehand that we can go through. Let me just pull them up here. I think John was going to go for the first one.
Sure, Matt. So the first question was, how do you value a shareholder buyout to make an initial offer without the need to involve a valuer from the outset? It's a tricky question. It's a tricky question. When I think people do it, but and then they rely on negotiations with the founders of the company to come up with an agreed value. But there's 6 ways of valuing a company, and in these instances where you've got startups, it's often very difficult to get solid information on which you can base a valuation. Common ones are the cost of reproducing the coding that they've done. Another one might be that if they're starting to generate revenue, if they're post no revenue and starting to generate some, then you may be able to use some discounted cash flows, but relying on those numbers can be fraud as well. So yeah, the valuers are there for a reason, and I'd suggest that you use those to cover yourself rather than trying to come up with some other method. Thanks, Matt.
Thanks, Sean. And so the next one here is, what costs, taxes, i.e. employee entitlements, need to be factored into the deal? So I guess here it depends what kind of transaction we're referring to, but generally with a business sale, there can be stamp duty that's payable. So depending on the states, there's different obligations that apply to stamp duty. So it in New South Wales doesn't apply to the transfer of business, but if there's a lease attached, then there can be stamp duty that's payable. So that needs to be kind of factored in. And with employee entitlements, I think it's, it's useful to understand what your obligations will be, because obviously those can sit as liabilities on the company. And so with a business sale, you're just knowing that you'll need to potentially pay those out, or that they will be sitting there in the case of a share sale, and confirming that what they are. But I think stamp duty is really the one to consider when it's actually a business sale or the transfer of the assets, which there's no stamp duty typically when there's a share sale. So over to John for the third one.
So the third question is, how do we deal with any undistributed profit? Now, it's a good one. If you've got undistributed profit in there, then you've probably got cash balances. But I guess the consideration that you need to think about very carefully when you're buying the business is, what working capital is it going to require to operate? So you've got to pay your wages and whatnot probably before you're going to collect your debtors. So you need to sit down and analyse what the working capital requirements are of the business. Generally, from my experience, it's in the interest of the vendor and the seller to reduce the excess cash in the business to the amount that's going to comfortably cover working capital. undistributed profits is an issue if it's a related party sale, because there's dividend stripping rules that need to be complied with. But if it's an arm's length transaction between two independent parties, that's probably going to be less of an issue. But yeah, very good question, and something that that needs to be considered before signing. Thanks, Matt.
Yeah. And so the fourth one here, I mean, I guess there could be accounting or legal elements, but is there anything specific when considering making an offer to buy a share in an online tech business rather than the whole business? So I guess the kind of two sides of the coin are buying just a small portion of shares in the company, and the other side being the whole business. So I guess that could be all the shares or just the asset. So I guess, I mean, you know, when you're only buying a portion of the shares in a company, you know, your bargaining power will be less. It depends on, you know, the nature of the seller who's selling those shares. And sometimes this is referred to like as a capital raise, that maybe you're just actually buying the new shares in the company and they're using that for the working capital, so that funds are going into the company, rather than if existing shareholders are selling their shares, then those funds are going to those existing shareholders. So it depends what the money is going to be used for. Like John was saying, if they need working capital, then it would typically be for the issue of new shares. I guess just to kind of cover off the difference there, I mean, you probably have less bargaining power if you're buying a smaller percentage, meaning that, you know, when it comes to warranties and due diligence, they might be less likely to kind of just open up the doors and the books to let you kind of have a look at everything and negotiate everything, because one, the deal size will be smaller, so the risk as the buyer will be smaller, and you're probably not playing the kind of key role that you would be if you're buying the whole business. So it's just kind of about the bargaining power and the level of risk and the intention of those funds, whether it's to give additional working capital for expansion or something, be the issue of new shares, or for the divestment of investors, divestment of like the initial founders, so they're selling their shares and they're taking some of those profits. So it really does depend on the deal size. And that was it in terms of the question. So hopefully, oh, sorry, there was one more question here, was around if we have checklists. And we do have another guide here on a due diligence guide when buying a business. So we might be able to actually add that into the blast that goes out. We'll have a look, but otherwise you can access that on LegalVision's website. You know, we do have quite a few articles and guides that you can basically just type LegalVision and type any sort of legal issue, and you'll have articles or guides that come up. But we have had, sorry, another question that has come in here. It is, what are the pros and cons of buying shares in the company versus buying the business? So, I mean, that's kind of what we've gone over here. I mean, the main thing being the liabilities as a buyer. You know, the pro of buying the shares is that you don't have to be responsible for the skeletons in the closet or the liabilities of that company, meaning that you don't have to worry about their debts to the ATO, their disputes necessarily with suppliers, although there can be practical elements of that if you require those suppliers. But generally, the risks of a asset or business sale as a purchaser is lower when it comes to the liabilities. Now, the reason you can do it is, one, sellers get an advantage usually, like John was talking about, and because where there's a company where there's existing contracts, say there's ongoing contracts with clients, there's tons of employees, there's equipment leases, having a share sale makes the process far easier because, you know, subject to any sort of change of control clauses, those contracts all stay on foot and the business continues to operate as it did before. So it's really a practical kind of smoothing out of the sale process for when it comes to a share sale. And The last question here is how to ensure the purchaser is not liable for the debts or liabilities of the vendor after settlement. So it depends on so just to repeat that, how to ensure the purchaser is not liable for the debts or liability of the vendor after settlement. So this really does depend on the type of sale. You know, if we're talking about a business sale, you know, the standard position in the contract should be that, you know, it basically says that the buyer is not responsible for anything, any of the past costs, claims, liabilities of the seller as it relates to the period before completion. So unless it talks about kind of employee entitlements and other kind of liabilities, then you're not responsible. And then the other side is a share sale, so that, you know, on the starting position is, you know, you're taking control of that company, so you're taking on its obligations, and so those liabilities can sit with you. And the two ways to combat that are to do due diligence, like we're talking about, John was talking about the ATO portal and making sure that they've reported taxes and earnings correctly, and that, you know, we can also address those via warranties in the sale agreement. I'm not sure if John had anything to add there, but feel free to.
Yeah, no, Matt, that's fine. So it does depend on whether it's an asset or business purchase versus share sales. But if you're purchasing these assets, then generally you're not going to be taking on any of the liabilities that under that agreement.
Yeah, correct. And so next point here. So hopefully you guys know, but generally, LegalVision is a membership-based law firm. So basically, we're encouraging kind of you know, ongoing relationships here, so that one, we can service you guys in a more efficient way, and then as well, it's more cost-effective. So essentially, you know, we have there's a weekly fee, and we look to cover all of your legal needs within that kind of weekly fee. And you get what's listed here. So trademark assistance, legal advice consultations. So you can book a call with a lawyer, I think it is 2 hours in advance. So if you want to have an issue that's popped up, you know, within 2 hours, you can generally book a call, get on the phone with a lawyer, which is quite helpful, instead of having to worry about getting a quote or seeing if people are available. And as well, we're kind of specialist lawyers. So we have various teams at LegalVision that deal with the individual areas. So IP team, disputes team, commercial team doing commercial contracts, corporate team, capital raising team. And so you know that you're getting lawyers that are kind of experienced in that specific area. So if you're interested, you can book a call with us. We can go through what's included. You get a complimentary consultation, and we'll go through your business with you, kind of figure out what your needs are, and then we can provide you with a quote for membership. I'm so keen to have more people on board, even though I can't see your faces. Be lovely to work with you guys.
Yeah, similarly, if you've got any other questions that flow out of today, or anything that might come up for in the future, then reach out to us. We're always happy to have a chat with anybody and help them out with information if required.
Yeah, so that's it. Thanks again, guys. We'll send you through those additional resources, so you can download that guide. We'll send you through this recording. It's been lovely to have you guys on here, even though we haven't heard from you. But I think I'd like to thank you for taking the time out of your day to have a listen. Hopefully you've gained a bit of insight, or even some questions that come out of it, which is still good for things to explore. And feel free to reach out to either LegalVision or John at Fraser Scott Co, and we'd be happy to have a chat.
Thanks, Matt. Thanks, everybody. Thanks for attending.